Welcome to This Explainer. Today, we're exploring a truly fascinating corner of the modern financial system. We're looking at how Muslim Americans are navigating an economy built almost entirely on debt to build lasting wealth, and get this, doing it completely without interest. It's a system that absolutely challenges the very foundation of how we typically think about achieving the American dream.
Okay, let's kick things off by defining a word you're going to hear a lot today: riba. In Islamic finance, riba translates to interest or usury, and it is strictly prohibited. And hey, this isn't just a general suggestion, it's a foundational rule. It literally means you cannot make money simply from the act of lending money. The core philosophy here is that money itself shouldn't magically grow without any real-world effort, risk, or trade attached to it.
Here's our roadmap for this explainer. First, the interest-free challenge. Second, halal home ownership. Third, funding businesses. Fourth, halal investing. And finally, redefining wealth.
All right, moving to Section 1, the interest-free challenge, navigating an interest-driven American economy. Think about that phrase for a second, Riba-Free roads. I mean, let's be real, the standard highway to wealth here in America is fundamentally paved with compound interest. Almost every piece of traditional financial advice out there relies on things like credit cards, standard mortgages, student loans, and high-yield savings accounts. If you can't use that highway, you have to forge an entirely new road from scratch to achieve financial stability and growth.
So here's the rub, the immense friction this creates. How on earth do you buy a house, start a small business, or invest for retirement when the everyday tools everybody else uses are completely off limits? If you can't just walk into a bank and sign up for a standard 30-year fixed-rate mortgage, how do you put a roof over your family's head? Well, it requires a complete structural reinvention of the American dream's financial mechanics.
Which brings us to Section 2, Halal Home Ownership Explained, buying a house without a traditional mortgage.
Look at this perfectly framed 16:9 side-by-side comparison. The difference between a traditional mortgage and halal co-ownership really boils down to renting money versus forming a true partnership. With a traditional mortgage, a bank lends you cash and you pay back that principal plus a percentage of interest, right? You're essentially just renting the cash. But the halal co-ownership model changes the paradigm completely. It is not a lender-borrower relationship. You and the financier are actual partners buying an asset together.
So how does this actually play out in the real world? Usually, it's structured legally through an LLC. Step 1. You and a financier buy the house together. Let's say you put down 20% and they cover the remaining 80%. Step 2. You make a monthly payment, but it's split. A portion of it is rent paid to the financier for the 80% of the house you don't own yet, and the rest goes toward buying out their equity. Over time, your ownership grows and the rent you owe shrinks. Finally, Step 3, you buy out their very last share, owning the home outright. And the best part? Not a single cent of interest was ever charged.
Okay, that beautifully covers homes, but it naturally leads us to a massive question. How do you fund a business without interest? If you've got a brilliant idea but zero startup capital, and you fundamentally cannot take out a standard small business loan, what exactly are your options?
Let's get into Section 3, funding businesses without interest, empowering entrepreneurs through shared risk.
The secret sauce here? Joint ventures. Instead of a typical fixed interest loan where the bank gets its cut regardless of whether the business succeeds or fails, entrepreneurs utilize profit sharing. Step 1 is forming a partnership agreement. Step 2 is the shared capital investment. The financier provides the funds while the entrepreneur brings the sweat equity, the labor, and the expertise. Step 3 is where the magic happens. Profit sharing. If the business makes a profit, they split it based on a pre-agreed percentage. But if the business takes a loss, the financial backer loses their money and the entrepreneur loses their time. It fundamentally aligns the risks and rewards.
We've tackled homes and storefronts, but as we look toward long-term wealth accumulation and retirement, we have to ask, is the stock market halal? Can you just open up a standard brokerage account and buy a total market index fund?
Let's look at Section 4, investing the halal way, building portfolios aligned with values. As you can see laid out here, halal investing isn't just a matter of dodging interest. It actively filters out specific industries to ensure ethical compliance. You'll see firm, non-negotiable exclusions for alcohol production or sales, gambling or casinos, and of course, conventional interest-based banks and financial institutions. I mean, you wouldn't buy stock in a major credit card company or a traditional bank, for example, because their entire core business model relies on riba.
This approach makes absolutely sure every single dollar invested aligns with the community's values. But wow, it requires a much deeper dive into a company's balance sheets than your average investor might take. Financial advisors in this space run incredibly deep, rigorous screens. For instance, a common rule is that a target company cannot have a debt-to-equity ratio higher than 33%, and their income from interest-bearing accounts must be strictly capped, usually around 5%. It creates this heavily vetted, ethically screened portfolio that allows folks to grow their retirement savings confidently.
Bringing it all home in Section 5, Redefining Wealth in America. The broader impact of alternative finance.
When you completely strip interest out of the equation, this system is forced to return to tangible assets, shared risk, and actual real equity. Think about how much of our global economy today is built on speculative debt. Just endlessly trading numbers on a screen that are totally disconnected from real-world value. The halal model demands that money must be tied to a tangible asset or a productive enterprise. When risk is truly shared, financiers are way more careful about what they fund, and entrepreneurs are supported by true partners.
So as we all navigate this global economy that's heavily burdened by debt, boom and bust cycles, and inflation, we really have to ask ourselves, could these alternative, interest-free financial models offer powerful lessons for everyone? It's a fascinating question that challenges us to rethink the very mechanics of wealth. Thanks so much for joining me on this explainer, and I'll catch you next time.